Hi, everyone. Thank you for joining our BigML partner webinar today. My name is Atakan Çetinsoy, VP of Predictive Applications for BigML. I'll be facilitating today's session. The presentation and the demo will be given by Stats4Trade CEO, founder, Jean-Marc Guillard, and his co-founder, Mike Stafne. Before I turn it over to them, a few quick reminders. We have reserved Q&A time at the end of the presentation, so be sure to stick around for that. During the session, you will all be muted. At the end, if you have questions, I will unmute you so you can ask them. And you're going to have to raise your virtual hand using your GoToWebinar client for that. You can also enter questions into the chat box during the presentation, and we'll do our best to answer them as we go. If you have a question that comes to your mind or any other comments after the presentation, you can always contact us at info@bigml.com, and we'll do our best to connect you with the Stats4Trade folks here. Without further ado, I'll let Jean-Marc and Mike tell us how they're utilizing machine learning to democratize the multi-billion euro investment market. Mike, please go ahead.
So my name is Mike Stafne. Welcome. On behalf of Jean-Marc Guillard, my partner, we are extremely pleased to have your attendance, and we want to thank BigML for allowing us to talk to you today about how we've implemented BigMTool's machine learning platform into our environment and how we're using it to democratize investing. And as we go through the slides, I will be referring back to this idea of democratized investing, which for us means offering investors, both private and professional, the advantages of active trading at a passive cost. That is the cost of a passive fund, such as an index fund. So without further ado, let me begin. So today, and I'm sure some of you at least are investors in securities, for example, stocks. There is a gap between investors' expectations and specifically active fund performance today. Oftentimes, the statistic is quoted that about 80% of actively managed funds do not beat indices. And that is certainly our subjective opinion. That's all based upon data that we have from the general media. And the issue today is performance. Low returns, lower than the indices, volatile markets, high fees, higher than index funds. And if you are performing lower than an index fund, then should one be paying a high fee with the expectation that the performance is better than an index? This all breeds a general mistrust among investors. It certainly has bred mistrust in my investing over the last 30 years. The expected performance are excess returns above the indices. For example, above the Dow Jones 30, if one is using that as a baseline. Minimize volatility, and we will, throughout our presentation, return to this idea of volatility. It's just not returns, it's also volatility. And volatility is a synonym for variance, which is essentially a measure of risk. Certainly fair value fees. If one is not beating the index, then charging high fees makes no sense. And if this expected performance is fulfilled, then you can start to gain trust among investors. So again, right now there exists a gap between performance and expected performance. So there needs to be a breakthrough to satisfy investors, to take the performance today and deliver the expected performance. And there are a couple of key enablers that are present today which allow Stats4Trade to help investors bridge this gap. First of all, in the gray box on the bottom right, the amount of data and the variety of stocks available. Second, the presence of powerful cloud and machine learning technologies. And third, a very sharp decline in trading fees that make active investing attractive. In fact, I'll mention two specifically. One is Robinhood in the United States. Robinhood is a new brokerage with about 63 million in funding, for example, from the founder of Netscape. Robinhood charges no fees to trade. There was another no-fee brokerage in Europe called DeZero, and they intend to offer a no-free brokerage in the coming weeks to months, according to their website. So with these key enablers, we will show you today how we can take the performance today and deliver the expected performance that investors demand. So there is a concept behind our approach, which you will see in the following slides. And this concept is based upon a different time frame to create alpha and low beta. Before I discuss this stylized chart here, let me just quickly review alpha and beta. So alpha is a measure of the performance of any portfolio, its return above a benchmark, like an index. So alpha is the return over a certain period of time above a benchmark. Beta is a measure of the relative variance of that portfolio against a benchmark. So a good example would be if one says I have a positive alpha with respect to the Dow Jones 30, that means over a certain period of time the return of that portfolio is above the Dow Jones. Similarly, a beta less than 1 indicates that the portfolio is less risky. It has less variance than the Dow Jones 30. And we'll talk more about that later. But our approach is based upon the following concept. In the upper corner here, you have high-frequency intraday trading, the so-called day traders, or the so-called, and professionals do this, of course. They use very specific but time-limited information, and they trade extremely fast in nanoseconds. In fact, physically, the closer you are to the trading floor in terms of infrastructure, the faster you are. On the bottom here, you have a long-term approach, what we call a la Warren Buffett. Intensive, which entails intensive time-consuming analysis, it can be very, very effective. But it also tends to be costly because you need experienced professionals who investigate and analyze the market and try to pick investment opportunities. Stats4Trade, we are in the middle. Probably closer to high-frequency intraday trading, although we don't rely upon intraday pricing. We use historical prices to consistently optimize trades on a week-month basis, that is, over days. Currently, it's over 20 days, but it can be adjusted to any time frame. We do not use intraday signals, we use daily signals. So we're between the two time frames, and that's important to understand because we feel strongly that there is opportunity between these two extremes. So I apologize in advance, the slide is quite boring, but we wanted to make sure that it's very clear. So what is our approach? Well, our approach is the following. We make data-driven decisions to actively and automatically manage a portfolio of securities, such as stocks, and we optimize both return and risk is measured by variance. It's available, our approach is available for different markets, ranging from the NASDAQ 100 and Dow Jones 30 in the States to a variety of markets in Europe. It can be extended. beyond what we offer today on our website. It offers a mixture of stocks in different markets under varying conditions. Our approach can learn, and it can be programmed based upon past situations. It, however, requires investor input for major decisions and special situations. A special situation would be a black swan event. For example, some type of event, geopolitical or even a horrific terrorist event, which can upset markets, or even macroeconomic policy decisions or fiscal decisions. So therefore, it requires periodic input for major decisions, special situations. But the idea is, to use an analogy from the aircraft industry, increasingly the car industry, the investor is the pilot of the plane. We provide the investor the automatic pilot. Well, that's all great, but how has our approach performed? And before discussing the details of our approach, the details, we thought it would be beneficial to give you a taste of how we perform. And what you're looking right now at is a live set of charts. In fact, if I click here, we will actually go to our website, which has the same information. It takes a little bit of time to load. You can do this as well. I've just magnified the same charts here, going back to the presentation. In the upper left-hand corner, you see our performance for a portfolio of, in this case, it's assuming an initial investment. Usually our standard portfolio for private investors is 10,000, in this case 10,000 euros. This assumes a certain set of parameters, which I'll discuss in a few slides later. But you see the performance set at 100 here at the beginning of January 2014. The yellow is Stats4Trade, our portfolio, using machine learning tools from BigML. The red is the CAC 40 index. And the blue curve here shows how much we are invested at any point in time. You notice it fluctuates, so we're not always invested in the market, which is quite different than a buy and hold strategy as represented by the red curve. So that blue curve fluctuates according to the buy signals, which are directly dependent upon the confidence intervals that we have chosen. And you see our relative performance. In the bottom left-hand corner, you see a measure of alpha and beta. And if you want any more information in how we calculate that, you can visit the website where we have a detailed help page on alpha and beta, and you can also ask any questions at the end of the presentation. But suffice to say, alpha, again, is a measure of relative return against the index, and beta is a measure of relative variance. And you read alpha here. Alpha here is 0.1. Multiply that by 100 to obtain percent, so it's 10%. So over the last 36 months, our relative return vis-a-vis the CAC 40 is 10%. Beta is the slope of this line, the 0.672. And because it's less than 1, it shows that we have less variance than the CAC 40 index, hence we're less risky. And this R-squared value here is a measure of the goodness of fit of that regression line. It's decent, I would say. It's okay. It should be, of course, 1 would be a perfect regression. It never exists, but 0.676 is okay. And it reflects on the estimates of alpha and beta. So you can see clearly that we are less risky than the CAC 40, and we have higher return. In the upper right-hand corner, you have the annualized returns, 14, 15, 16, to date, 2017, and the average return over those 3 years. The average return is a geometric return, by the way, so it is compounded. And in the bottom right-hand corner, you see our returns distribution. And for the CAC 40, you can see from, let's see, from purple all the way to green, those are positive trades, and from this dark green to blue, those are negative trades. And you clearly see that the number of positive trades is higher than the number of negative trades. It's in fact about 60%. So if you could imagine a casino, by law, most casinos 52% programmed gains. In our case, we have about 60%. And that difference between positive and negative gains is how we're able to squeeze returns above the index out of the market. I went into a little detail about these slides because these figures, or these charts rather, because you will see them throughout the presentation. Oops. Okay, so I'm going to give the presentation to my colleague Jean-Marc Guillard, who will tell you how this works in detail from our side as well as from BigML's side, and how BigML plays a substantial role in our approach. So Jean-Marc, I give you the presentation.
Thank you, Mike. And good morning or good afternoon, everybody. So first, before I explain what is the problem we are solving, one thing I would like to add about the previous slide is we show results for 2014, 15, and 16 because it's really test data. When we train our models, we use data only up to end of 2013. And really to be able to make some live test on something we can trust, year 14, 15, 16 are only used for tests. So I think it's important because this is why we are very confident with our result. Okay, this being said, what is the problem we want to solve? Or what is the problem that everybody who wants to invest on the stock market has to solve? It's really an optimization problem. What you need to do if you want to invest on the stock market and try to do better than average is you need to think about what are the stocks that can go up in the time frame you want to invest. So, because you only want to invest on stocks that will go up. So the first question you ask yourself is, what are the stocks that are good candidates to go up on my time horizon? Then you also need to think about how much do I buy of each of those stocks, because you may find different candidates. And so how do you spread your capital among those different stocks? And this is not difficult enough. You also have an additional variable, that is, when do you invest? Do you decide to invest all your capital on different stocks in one day, 1 week? Or do you want to smooth and try to optimize your risk by targeting different days, different weeks, even different months? So it's really an optimization problem where even if you know the stocks that are supposed to go up in X months, X weeks, you still need to work on how do you spread your capital. So, and that's why we consider that we have a prediction problem. The first one, that is, what are the stocks who are candidate to go up? On an optimization problem, that is, after, how do you spread your money? How do you invest to be sure that you maximize your return without taking unnecessary risk? So this is really the problem that we have to solve: prediction and optimization. So Mike, if you can go on the next one. So really, we are using BigML for the prediction part to determine what are the stocks that can go up. Here in this case, it is what are the stocks who can go up in the next 20 days. And then to be able to determine when to invest and how much do we want to invest, we really try to diversify as much as possible. You may imagine different strategy because again, it's an optimization problem. Depending on what is very important for you, you may decide to put more weights on this or this. But here, what we have decided to do is be able to spread the risk as much as possible. So we spread the investment across the 20 days or n days if we do prediction for a different time frame. And we try to optimize the amount per stock to keep it even between the different opportunities. By saying, okay, we are taking the prediction from BigML. BigML is confident that the prediction is correct. Let's just take different stocks, different prediction, and consider all of them as being realistic, and just be even for the money we put on the different stocks. So maybe it's better to see this with an example. So really keep in mind that you have this kind of problem to solve when you invest on the stock market. And this is why it's difficult to beat the market, because it's not a game where you can just follow your instinct, wake up in the morning and say, oh, it's a good day, I feel good about this stock. This can go up in the next 20 days or the next month and so on. You have a lot of work to do to be sure that your strategy is something you can reproduce on something that does allow to well manage your risk. So go on to the next slide, Mike. So here it's a very simple example. So suppose you have 4,000, let's say USD, that you want to invest on the stock market, and you decide to split your 4,000 into 4 lines. 4 lines means that every time you invest, we call this a line, and here it means you will invest around 1,000 per line. And to be able to diversify, you will say, I don't want to have more than 25% of my capital on any given stocks. Which means if you want to be invested at 100%, you need at least to have 4 different stocks in your portfolio. So let us see how does it work. Go on to the next one, Mike. Okay, so the first thing is you need to have good signal to know, okay, it's a good time to buy. And again, this is where BigML is helping us be able to identify this timing, these windows where the opportunity to buy seems to be quite good. So you start to enter in one of those windows. Go ahead, Mike. So then we will invest, and again, the idea is to spread it among the different days. So at the beginning, you will buy 1 stock. This is the first line, and we want to spread it across the 20 days. So here it means that every 5 days, we will buy a new stock. And why every 5 days? It's just because you have a 20 days window for the prediction period. You have 4 lines, and if you want to spread your risk from a timing standpoint, you have to wait for 5 days once you have booked something to buy the next stocks. So it may take you around 20 days to be fully invested. And again, you invest only if BigML is telling you it's a good time to buy. The confidence is reasonable that this stock will go up in the next 20 days. And once you have reached full exposure of your portfolio, you wait for 20 days, and after 20 days, you sell the given stock that is expired. And then you iterate. You can go on to the next one, Michael. And then you roll your position. And of course, to be able to roll your position means you need to have a new trigger. You need to have a new opportunity. And this opportunity may not come straight away. You may have to wait because either markets are declining or the price is too high. Whatever makes BigML not confident that he can make a good bet on the fact that the stock will go up. So you may have to wait, and that's why Mike was speaking about the blue curve, that you are not necessarily invested at 100% all the time. When you are not invested, it just means that we didn't find a good trigger to be invested. And if we don't find a good trigger to be invested, better to wait rather than taking unnecessary risk. So you first invest, you are invested at 100%, then you sell after 20 days when your position is expired, and when the new signals are coming, you ramp up again, and so on. So it's really the way it works. Be able to make the prediction from BigML on this kind of optimization to smooth the risk while maximizing the return. You can go on the next one, Mike. Okay, so here it's really a kind of matrix to show you visually how it looks like. The different columns are corresponding to the different stocks of a given index, and the different rows are corresponding to different days. So you can see that there is time where you can find a lot of stocks that are interesting to buy, and you have time period where you have far less opportunity. The density of the matrix is not the same every time. And again, it's just because you have time that are better than others to buy stock. And inside a given time period, you have stocks that are better than others to buy. And this is really what we do, make this kind of prediction. Then we select them based on the level of confidence, because the big things from BigML we like is not only you have the prediction, but thanks to Ensemble, thanks to different features in BigML, you can also have the confidence coming with your prediction. So do you have 60%, 65%, this kind of things. And this is what we use. And the concept of number of investment lines is really here to be able to minimize risk, diversify as much as possible, because if you are like us, you don't want to bet everything on one single thing. You don't want to say, oh, this stock has a very good confidence level, so let's bet everything on this one. No, you still need to acknowledge that even if the confidence is good, the better it can be, it's about 65, 70% sometimes. But you still have a 30% that it goes on the wrong direction. And the best way to mitigate for this is really diversification. So what we propose is really a mix of the two things. Use BigML, use machine learning for what it is doing very well. Be able to make unitary prediction on a single event, and then be able after to mix those different signals in a way where we can diversify risk, diversify investments. And Mike will now show you at the end, if you want to use our approach, what are the key parameters, how does it translate for the investor? Is it something complex to use, or do you have parameters making sense, something that you can feel comfortable with to make a decision? Mike?
Okay, so let me begin by clearly stating we use our own data, our own application to trade. And we're in the midst of rolling out a beta version of our application, which will be available to interested private investors. And if there are any professional investors, this application is also available for them, for example, fund managers, and we would, in the future, we plan to have conversations with funds. But let me emphasize, we trade with our own tool. So what does our application look like, or not look like? What does our application need to generate data for a typical private investor to trade actively? So the available parameters today we have are, you choose your market, as you see in the box in the middle. Right now we cover the Dow Jones 30 and all the stocks in it, the NASDAQ 100, the Euro Stoxx 50, the CAC 40, and the DAX in Germany. You choose your initial capital. You choose how you want to divide that initial capital equally, that is the number of investment lines. You choose the maximum value that you can be invested in any one given stock. You choose your buy confidence, you choose your sell confidence, you choose an investment mode, whether it be maximize your return or minimize turnover, because we do generate capital gains as well as capital losses. And the application will tell you which stocks to buy and to sell on a daily basis. Right now the application is manual, but in the near future we will automate it with the no-fee trading platforms which I mentioned earlier, Robinhood in the US and Zero in Europe. So we have a standard portfolio on our website. In fact, if you are online right now, you can go to our website at Stats4Trade.com. And if you look at the market for private investors for the Dow Jones 30, you will see the same data that I will present on the next slide here. And that data, the results, are dictated by the parameters that we use. And the parameters are as follows. It's the Dow Jones 30, initial capital of 10,000. And by the way, let me emphasize, we are trading today with 10,000. Number of investment lines 10. Maximum ratio of any given stock is 10%. Buy confidence is 65. A sell confidence is 100, which means we don't, after the end of 20 days, we sell automatically. We don't maintain the position dependent upon the following 20 days, but you have that opportunity. And we've chosen for our own money to maximize return. So let's see how we've done. And again, if you're online, you can go to this link here, and you will see our performance live. So here we have the development of our portfolio since January 2014. Let me emphasize, we only began live trading at the beginning of this month. So we cannot say that we have realized the return shown by the yellow curve in the performance. It's only since beginning of this year. Here you have alpha and beta. I'll go into more detail in the following slide about that. Here you see the annual returns, our portfolio versus the Dow Jones 30 average. And every year there's been an alpha, a positive alpha. And here you have the breakdown of the returns distribution, and I'll show a slide that shows more detail. Let's first discuss alpha and beta. Oops. So this is a zoom in of alpha and beta for our portfolio over the last 36 months. And here you see beta. Beta is the slope of the curve, the regress curve, through the monthly returns that you see plotted. So we plotted our return as a function of the Dow Jones 30 return. We plotted all those monthly returns. Those monthly returns are annualized before we plot. We plot, and then we regress the line. The slope of the line is called beta, and beta is a measure of relative variance, that is relative risk. The slope of the line is 1.003, it's essentially 1. Therefore, by definition from financial theory, we have the same risk as the index. Alpha is the y-intercept. It's where the regress line crosses the 0 axis. You can see here it's 0.069, multiply by 100 to obtain a percent value, and our alpha over the last 36 months is greater than 0. It's greater than the index. That means we have outperformed the index. And by the way, we use the Morningstar definition to generate these plots. The only difference is we have not subtracted out the risk-free rate from either return. In doing, we realize that theoretically that's the way the Morningstar reports it, but there are two reasons. One, risk-free rates are not always clear which ones you should use outside the United States. Number two, they're very low. In an era of easy money from central banks, they're in some cases less than 0, for example, in Europe. And it only affects alpha. So if you really want the true Morningstar alpha definition, for this you would subtract out the 90-day Treasury bill rate, which is very low right now. So in the entrance of being completely transparent, there is a bit of a difference, but suffice to say it's a second order difference, and it does not affect beta. So the point is we've done better. We have the same risk as the market, but we have alpha. That means we've outperformed the market. And the accuracy of these two estimates for beta and alpha is here reflected by the R-squared value. It's a measure of goodness of fit for the regression. It's 0.865. It's a decent regression. So that means that there is the estimates that we have for alpha and beta are fairly accurate. Let me zoom in on the returns distribution. We feel this is an important chart because it shows you how many times we've had a positive return and how many times we've had a negative return. And I mentioned earlier in the presentation casinos. Casinos by law are able to pre-program in games that offer them an advantage, say 51%, 52%. In this case, we have an advantage of about 60% in this game, which is actively trading in the Dow Jones 30. And this is over the last 36 months. And we do not ever tell any persons, investors interested in using our applications that you will always have a gain. It's absolutely false. No one can promise this. What we say is over time, and it takes about 6 months because you need enough data points, the power of statistics, the power of our method begins to show itself, and you start to see over time the confidence intervals that we have used as trading parameters, they start to reflect themselves in our returns. And in this case, over 3 years, you see 60% of the time we have a gain and about 40% of the time we have a loss. Want to mention caution with trading parameters. It's not so clear-cut sometimes. You have to be very, very careful. And I want to mention one particular trap regarding confidence intervals. And so we've noticed with some of our beta users, trusted beta users, I would say, that they tend to try the corner cases first. A corner case would be, well, I will dial in 90% confidence. Be careful. 90% confidence can create real problems because what you end up doing is you have so few stocks to choose from, and typically the confidence is never 90%. So let's give a better example, say 80%, which is very rare. You might have 1 or 2 stocks per month. And if you're only trading in 1 or 2 stocks per month, you've automatically increased your variance, your risk, because you only have 1 or 2 data points. And so at that point, statistics is no longer playing a role. And so you're heavily exposed. And you see that in some of the simulations we've done as we've even progressed through 62%. We're using 65% in our standard portfolio, but you start to see with lots of investment lines, and that implies a lot of stocks and a lot of initial capital, that you start to see a drop-off in performance when you start using the higher confidence intervals. And the reason is you start to have fewer investment opportunities. So the number of data points is increasing. And as we all know, you need statistics relies upon many samples, as many samples as you can get, of course. And so be careful with confidence. And especially for the layperson who's not familiar with advanced statistics, it can be a real trap. And so we're careful to educate people about this, although we leave it open as a parameter for the user to choose. The approach is scalable, and that's something that we want to emphasize. I just showed you our online results for a private investor with about 10,000, well, in our case, 10,000 in capital, initial capital. The tool is also available, or the application is also available for professional investors. Certainly they'll have access to more capital, and it scales. In this case, and it's on the website, you can just click here, and you'll see it, the same data as it's populating. In this case, the Dow Jones 30, we have initial capital of 600,000. We have a number of investment lines 600, so we're trading in 600 individual stocks, possibly, over a 20-day period. The same max ratio, the same buy and sell confidence, the same maximize return. And what you see is something very interesting. You don't see the same alpha. The alpha is now lower, about half as it was before. However, the beta is significantly lower. The beta, it's hard to see here. If you go to the website, you can see it better. It's 0.662. So we have, through the fact that we have increased the number of stocks that we're trading in, we have automatically decreased our risk substantially through a decrease in variance. You quite clearly see this. So this is an example of how increasing the number of stocks can decrease risk, but it necessarily doesn't increase your return. Whoops, I apologize. I'm out of synchronization here. Okay, so to emphasize, for our private portfolio, we invest our own capital, and you can see the results on the website. The results are scalable. Be careful with confidence as well as other parameters, specifically confidence. And if you want information, you can also visit our website, and you can also send us questions via our website, and certainly at the end of this presentation. So at that point, I want to thank you for your patience. I'm going to give the last two slides to my colleague Jean-Marc, and he will wrap up.
Thank you. So before we wrap up, so what we have seen before is if you want to bet the market, you need to solve an optimization problem. And what we have implemented to be able to solve this implementation problem, but not just the one with 20 days, because we want to be able to manage different time frames in the future, or even different markets. So we have developed something quite flexible around BigML, because BigML is a key tool for prediction. But as we have shown before, we need more than prediction to provide a full investment strategy. So the first thing we do is be able to collect data. So far, we are using adjusted quotes from the index on all its components from the 90s up to today. When I say today, it's not totally correct. It's up to end of 2013. And information we are using is just price. Open, high, low, close on a daily frequency. Once we have collected the data, to be able to have BigML performing well, we need to make data more intelligent. It is what we all know, it's develop your own feature. And for this, what we do is a kind of multi-frequency analysis. We analyze the data on a daily, weekly, monthly, on semester basis to be able to highlight some trends, some characteristics of the stocks. And at the same time, we want to be able to compare different stocks because what we are doing basically is use the fact that there are a lot of correlation between the different stocks. One stock on the big index will not go up alone. Usually, you have different stocks going up at the same time. And this is the kind of things we try to highlight in the features we compute. Once we have done this, we have an automatic connection with BigML, and here we are using not all, but different APIs from BigML to build the source, the dataset, the ensemble, make batch prediction, a lot of things like this. And we use this automation between the data we compute on BigML to be able to train the models, validate different features, because as you may imagine, it's not so easy to know right away what are the key information you need to be able to make a good prediction with not too much variance. Because this is an important part of the test we are doing is once we have the prediction, be sure that the prediction can be used in an interesting strategy. And for us, interesting strategy is really what Mike showed you before. Be able to show your level of risk with the confidence, be able to determine the amount you want to invest, and have something that scales relatively nicely from small portfolio to quite large portfolio. So this is the kind of test we do because we don't want to have all the prediction for a very limited time window. We don't want to invest everything in 1 week or even in few weeks. We want something that will generate accurate or as accurate as possible signals across time, across years, because we want something that you can replicate on something we can trust, even if there is always a risk with statistics because we can never be sure. But be on the safe side by saying, okay, it's not just something that will happen once a year, it's something that is very regular. So this is the work we do, and we have done it in a very flexible way by using Google Script because we want to be able to iterate very fast. And for me, when you want to work with machine learning, it's very important to be clear on what your success criteria is. How do you measure success of a good prediction? This is the test part. You always need to start with this. How do you validate your prediction upfront? And then it's your goal. As soon as you start, you want to be as fast as possible to go from your raw data to test with your key metric. And to minimize the time between initial set of data and first test, you want something extremely flexible, something that does not take too much time, effort, or maintenance with database and so on. And that's why we have chosen this environment with Google Script. It gives us something that is fully automatized, that runs every night, and that is quite reliable right now. But at the same time, that is allowing us to be extremely flexible, change things very, very fast, and adapt to new things we want to highlight. So this is the way we have implemented it. So behind the scene, in addition to the optimization problem we have described before, we have this platform. And of course, BigML is a big part of it, but it's not just BigML. Okay, now for the conclusion. So really, when we have started this with Mike, it's really with this idea that today it's too difficult to invest in the stock market, but you don't have a choice. If you want to make decent return with your saving, one way or the other, you need to be on the stock market. So what we want to do is really provide something that people can trust, something that people can experience, can test. Because again, if you want to be successful on the stock market, better for you to not make your decision on the fly just when you wake up, just based on your instinct. You need to test, you need to validate your strategy. And we wanted to do it in a way that is not too complex for people, where they have to understand what they are doing without having a bachelor in mathematics. And that's why we came up with this idea to say, okay, how much diversified do you want to be? How many stocks do you want to have in your portfolio to be fully invested? This is the first question you have to answer. Then it's, do you prefer to be invested most of the time or more when risks are relatively low? And this is something you choose with the confidence level. You pick 55 to 60% if you want to be invested all the time. If you want to be sure that you are not taking unnecessary risk, but you are ready for this, to give up some of the returns, you go more on the safe side with 65. And then you decide how much do you want for a given stock to weight in your portfolio, and that's it. Then you can make the simulation, and you can get in your mailbox or tomorrow the automatization with the broker on the program will buy and sell the stocks for you. But you have to do this work, and we think that with this now we can deliver on our mission to really democratize investment on the stock market. We are validating this with some beta user, but we would love to hear your feedback about this. What do you think about this? Is it clear enough? Is it something you are ready to test? It will be quite interesting. And I think that this concludes this presentation, and it may be time to open for the questions.
Great. Thank you, Jean-Marc and Mike, for the in-depth explanation of how you approach this complex problem. And definitely glad to see that you've been able to drive value from the BigML platform by making it a core component of it. At this point, I'd like to open it up for questions from the audience. You should have a small hand button, an open hand button on your client app. If you click that, I'll be able to see that you raised your hand, and I'll unmute you so you can ask your question. And I'll give you a couple minutes as you do that. In the meanwhile, I wanted to ask a question to the Stats4Trade team myself. When you set out to create the system, you obviously probably didn't have an understanding of exactly which direction it's going to end up going. Based on your experience, especially using the BigML platform to build your models, working with your data, what would you say the parts where you had to spend more effort than you originally expected versus less? So has it been sort of on the mark in terms of where you end up spending more time? Or was it different than what you expected to begin with when you set out to implement your system?
I can answer. The difficult part of the problem is really the variance coming with the prediction. It's very, very difficult to have something that will perform consistently across time. You can get good prediction relatively fast. But if now you want to have prediction with a confidence what you can use, you have to spend a lot of time. And this is not linked to BigML or whatever. It's just because the problem is extremely difficult and you have a lot of variance. So you need to find a way to mitigate this variance. And this has been far more difficult than what I was thinking.
Jean-Marc, wouldn't you also say that data preparation before even processing with BigML, data preparation is important?
It's key, but here it was expected. So it was expected to have to spend some time, but now it doesn't make it easy. It's still something where you have to spend a lot of time.
All right, thank you for that answer. There is a question from the audience that came through the chat channel. Preet asks, could you please explain how you get the confidence figure?
So how
the confidence value, the confidence, the percentage value for a given.
So I assume the question is related to how BigML generates that number, as opposed to us giving it. For example, let me try to answer it from the user standpoint, and then Jean-Marc, if you want, you can complete my answer on the BigML side. So when in our application, you have the ability to input a buy confidence as well as a sell confidence. Now, of course, you would never pick anything less than 50% unless you want to lose money. But you also, per my previous discussion, you wouldn't pick something too high. For example, above 70, you start to have less data points, that is, less stocks to buy and sell, and you increase your risk. So that then begs the question, what is an optimal value between 50 and, say, let's say 70% to buy and to sell? And that is dependent upon one's own risk profile. If one has a large appetite for risk and one doesn't have so much capital to invest, I would recommend a higher confidence interval, knowing that you're increasing your risk. But you will also probably increase your returns. If you have less appetite for risk, probably less, and this is for a small portfolio. I'm not talking for a large portfolio of many stocks. This is for a few stocks. You'd probably want to lower that confidence intervals to say between 55 and 60, because then you'll have more stocks to choose to buy and to sell, and you decrease your risk by decreasing variance. But it all depends. And the process of generating those confidence for selecting those stocks that have a higher confidence or a lower confidence above the threshold that one chooses, that's a BigML process that we rely upon. I hope I answered the question adequately enough.
Thank you. I think maybe from a BigML perspective, I can add that depending on which modeling techniques that you use on the platform, there are certain statistical tests that are conducted behind the scenes to be able to compute the confidence values for a given prediction. Obviously, those range from 0% to 100%, but mainly they are somewhere in the middle. In the case of the decision tree models, for example, I believe the system uses the lower bound of the Wilson score interval, but I'm not a statistician myself, so I would like to refer the audience to our online documentation. We have a lot of documentation that goes through all these important details for every technique that we offer on the platform, be it supervised or unsupervised learning. So that's basically how these values are generated. And it does depend on your machine learning workflow, the algorithms that you choose to use, etc. All right. One more question from Ular, I believe. He's asking, how long stock time series have you used for training the models? How long of a stock time series have you used for training the models?
Around 20 years, because we start with the 90s, So from 90 something to 2013. So a little more than 20 years.
Okay.
And Jean-Marc, correct me if I'm wrong, we, for example, Dow Jones data goes back much longer than that, but we specifically chose 20 years, around 20 years because of electronic trading, beginning around the early 90s.
Yes, you have this, and then you have some rounding error into the terms, as different things. So it's difficult to go above 20 years. Or maybe the question was different, is when we do a given prediction for a given instance, we use around 6 months of data. So the feature we build for any given prediction are using around 6 months of data.
That's great. I don't have any other questions right now, but I'll ask one more myself. So in terms of, I mean, it sounds like you started with the French index as your test bed, and then later on added different indexes, including Dow Jones 30. I mean, did you have to drastically or in any way really change your implementation, your system when you're trying to adapt to different geographies, or was it just plug in a different data set?
A little of both, in fact. Every time you take a new index, because every model comes with some limitation. So what you want to test first with different indexes is, are your results consistent? And yes, results were consistent between the different indexes. But at the same time, we saw some limitation, and we had to improve the features to be able to detect more patterns, more difficult situations. So use index for us, use different indexes is a way to validate things. Is it consistent? Can we replicate? And secondly, in what is different, how does it help us to improve? So it's really an iterative work. So there is a lot of value on working on as many indexes as possible. You get different ideas and so on. You cross-check your model much more when you do this than being on just one market.
I see. Okay, great. One more question from Mular. How robust are the models under different market conditions? And do you need tuned models for specific market conditions? For example, a very negative market, does that require a completely different model or approach?
No, maybe Mike, can you go on the website?
Sure.
We can show you, because what is good is if you have a look on the different markets, they didn't perform the same way during the last 3 years. So for instance, if we look on the Euro stocks, so the Euro stocks is really the 50 biggest stocks in Europe. And if you have a look on the red curve, you can see a really strong decline starting around April, May 2015 up to end of January 2016. It was really a sharp decline. And then it started to rebound. And you can see that here we have been able to handle this correctly. We had some losses at the beginning, but then it was able to do far better at the end of 2015 and perform quite well in 2016. This is exactly the same model we are using for the Dow Jones. If you go on the Dow Jones, Mike. So here you didn't have a sharp decline on the Dow Jones. You still have one, because 2015 was a difficult year for every market, but it was not as bad as in Europe. And here you can see that with the same approach, same models, we are able to handle the increase quite nicely. And we want really to avoid to have to customize things for a specific time frame or a specific situation. Because if we start to do this, then it's difficult to develop trust with the model. And when I say trust, it's reasonable trust. You need to accept that there is some limitation. It cannot be perfect. And there will always be a situation where the model is showing limitation and does not perform as good as it should, or at least as good as you expect. But nevertheless, if you have been able to test the model in different situations, different configurations, you will be able to get an idea about what the limitations are, how it will behave. And thanks to this, you know how to use it. It's really like we come from the CAD industry, from the PLM industry, where engineers are using a CAD system to design a mechanical assembly, and then they are using analysis to simulate how it will perform. Simulations are coming with a lot of limitation. It cannot be perfect. It's not fully real life. Nevertheless, if you know well your simulation software, you start to get a good idea about is your assembly correct and can you start to manufacture it with good confidence and use it. And here it's the same approach. If we do something that is relatively generic, people can test it in different configurations. Again, it does not make it perfect, but you can develop a good knowledge about things it does handle well and things it does not handle so well. And for things it does not handle so well, when you see that you are in this kind of window, better for you to start to take control. And that's why we speak about the automatic pilot. We are not pretentious to say, oh, we know how to manage every situation or whatever. We're able to manage a good set of situations quite well. But if you see some limitation, better for you to take the hand when this is happening. So sorry, maybe I was very long, but it was to give to try to be as complete as possible.
Thank you for that, Jean-Marc. So one more question from Preet. Do you generate sell signals in addition to buy signals?
Yes.
I will say no, Mike.
Well, it's we do have sell. Let me just preface it by saying we do tell through the. I'm speaking from our application standpoint. Our application does tell the user when they should sell, depending on the parameters they entered.
We give all the information to people on when to buy, when to sell, what to buy, and what to sell.
But the signals are dependent upon increases in price.
Yes, we are not able to determine when the market will decline. What we can determine is there is time that are looking risky to invest, and then we will have less opportunities. We still have a lot of work to do to be able to short the market. And to be honest, it's not our main target. Our main target is really for people who are trying to mitigate the risk, optimize the return, but we don't think that the main market is about people who want to short the market.
The models are optimized for calls, not for puts. They're not developed for short positions. That is any type of prediction of a price decrease.
So I mean, my interpretation is, like you said, it's either in the market or it's out of the market, but there's no separate short signal. But as part of your portfolio trading for the long positions, there is a set window that your model's assuming. So at the end of that window, there is a sell event, but it's not necessarily driven by a prediction of the market going down X percentage in the next Y days. It's just the nature of how you select to do your long portfolio.
Exactly. And moreover, please, if you were ever a beta user or a user in the future, in fact, right now our portfolio, which we trade, is actually on our website. We offer it right now for to everyone. Do not use that. Do not use any of our data for any type of short selling.
Okay, I think that concludes the questions that we have online, and unless there is any last minute question coming up right now, I'd like to thank our audience, and I'd like to give a special thank you to both of our presenters for being very candid and direct about their approach and its pros and cons. I hope everyone has been able to get some inspiring ideas from these presentations. I will also mention that we intend to send you a link to the webinar recording in the next 48 hours via email. If you have any other questions for either Mike or Jean-Marc, we will also provide their emails in that communication, so you'll be able to directly contact them. And again, thank you for attending, and have a great rest of the week.